Hey, welcome everybody. We're excited to have you here. We just want to run through this great deal here in South Carolina real quick. And so we're going to kick this off with Tim Vitale. He's going to tell us a little bit about the players behind this great deal.
Hi, Maria. Thanks for the quick introduction. Yeah, so this deal is in Walterboro and Georgetown, South Carolina. It's a 110 unit portfolio. I quickly want to talk about the disclaimer. Obviously, this goes without saying, but this is for 506C accredited investors only. If you don't know what an accredited investor is, please reach out to Maria, Beth, or Angie in order to ask the question. It's clear to say here that most of the projections and forecasts in this underwriting are simply that, projections and forecasts. We rely heavily on our area expertise and the property management companies that we've partnered with, and also the deals that we already own in the area in order to build these projections and forecasts. So none of these results are guaranteed. Obviously, there's always inherent risk with investing in real estate. So we highly recommend that you do your own due diligence on these properties before you do your own investing. They've been thoroughly vetted by us as the sponsorship team, and that's why we're presenting these deals to you today. So you want to go to the next slide? So quick team update. I'm Tim Vitale. I own Upside Capital. I do this full time. In my W-2 life, I was the assistant VP of finance for a Fortune 500 insurance company on Wall Street in Manhattan. I worked up to AVP. I was 28 years old and the youngest person in my organization to ever do that. Quickly realized that it wasn't where I really wanted to go in my life and started to make a pivot towards real estate. And I've been doing this full time since September 2021. So fairly recently, but we have bought a significant amount of property in the last year. I've partnered with some great people. Tim Vest, he's the owner of Harvest Properties. He lives in Charlotte, North Carolina. He's been doing real estate for 20 plus years, everything from fix and flips to land deals to partnering with us on multiple multifamily apartment buildings and hotels as well. Robert Musso, same story. He's been doing this for more than 20 years. He's done over 83 transactions in his professional career. He lives in New Jersey and is the owner of Tucson Properties. And lastly, we have Jude Visconto, who is Robert's main partner. They've been working together since early 2000s, I believe. He was in the same realm of doing multifamily fix and flips and smaller multifamily developments and conversions and things like that. So the team that we've assembled has a really good, really in-depth, well-rounded experience bucket to bring to the table. And we're really excited to be partnering with Maria, Beth, and Angie on this opportunity in South Carolina. So I'll let them introduce themselves really quickly because they're on this call.
So again, I'm Maria, and I'm the founder of Blue Vikings Capital. I've been doing real estate since 1996, started in the single family home like so many other people, and then transitioned over to multifamily, where I just found you could grow and scale so much faster, and have been really happy in this realm. And this is what I'm doing full time now. So Angie?
I'm the founder of Ohana Investment Partners. I've been actively and passively investing in real estate since 2018 and retired myself from corporate in 2019. So I'm very passionate about the gift of passive real estate investing, and that's why I founded Ohana Investment Partners, to bring that gift to as many people as possible. So I am still active and passively operating as a co-GP, an LP, a fund manager, and a private lender as well.
Beth?
Thanks, Maria. I'm Beth Underhill. I'm the founder of Lifestyle Equities Group. I've been a serial entrepreneur for over 25 years. And during that time, my husband and I have owned and operated a construction company building outdoor living spaces, as well as dabbled in real estate. But it was about 4 years ago that I actually jumped into real estate full time, began with single family homes, fixing and flipping, and then pivoted into the multifamily space. I have equity in over 500 multifamily units, as well as an RV park and a hotel in Panama, Central America. So I look forward to continuing my journey in real estate and seeing how I can help others, not just acquire assets, but also help others just find functional, safe, clean environments to call home.
Excellent. Oh, Tim, we lost your mic there.
Sorry about that. So this is a little sample of properties that myself, Tim Vest, and Robert Musso own. Collectively, it's around 1,100 doors spread between various locations, but the most of our concentration has been in North and South Carolina. That's where we would say is our expertise. This equates to about $100 million, a little more than $100 million assets under management as of the time of this recording.
All right, we'll take it over to Angie, who's going to tell us a little bit about the markets that we're going to be working in.
Okay, so these markets, both Georgetown and Walterboro, are close to Myrtle Beach and also Charleston, South Carolina. Georgetown is actually the second largest seaport in South Carolina. It's located conveniently between Charleston and Myrtle Beach, and it offers offers workforce housing to high demand areas of employment. But these areas of employment are also, because they're so desirable, they're also some of the most expensive areas to live. So a lot of the workforce does reside in Georgetown. And if we switch over to Walterboro, we'll talk a little bit about that as well. So Walterboro is an easy commute to both Summerville and Charleston, South Carolina. Again, desirable but expensive areas. More jobs are moving into Walterboro. So Gulf Foods brought in about $46 million into this submarket, which is significant for Walterboro, and they provided over 100 new jobs to the total of 200 new jobs, which were recently added to the area. So with this influx of money and jobs coming in, you have increased wages. You also have an increased demand for housing. Walterboro is also close to Charleston and Savannah and along the I-95 corridor. So both markets, because they're close to major metro areas, they are experiencing the byproduct growth of both Charleston and Myrtle Beach. So that being said, I'm going to hand it over to Beth to talk a little bit about the assets in the portfolio.
Thanks, Angie. As Angie said, this is a portfolio that is in South Carolina. It is comprised of 3 properties. And one thing I want to say first is that even though there are 3 properties, you are investing in the total of the portfolio. We have shown the returns here for each of the individual properties, but this is combined together as a portfolio. First off, we have Seaside Residential, which is located in Georgetown, and Georgetown is on the outskirts of the Myrtle Beach MSA, so we are considering this part of the Myrtle Beach MSA. And then we have Artisan West and Artisan Residential. Those properties are located 1 mile from one another, and they are in Walterboro, which is outside of the Charleston MSA. These properties supply the demand in the market for workforce housing within commuting distance from the South Carolina port cities. The properties themselves were built in the early 2000s, between 2004 and 2008. They are very well maintained with little deferred maintenance and are 100% occupied with waiting lists. That's a property owner's dream. The properties themselves are attractive due to the high demand for rental property in both areas, with the fact that there are no scheduled starts for new deliveries in either area. So that is a big plus for us. But the real opportunity with these assets lie within the low or the LIHTC housing status that they have. And LIHTC stands for Low Income Housing Tax Credit. 72% of the units will be exiting out of the LIHTC status over the course of the next 18 months. This is going to allow for the opportunity to take the rents from a current average of around $550 per unit to something close to $1,000 plus unit on average. Now, the nuance as to how these properties are currently working, because they are coming out of LIHTC over the course of these next 18 months, they're in what's called a sunset period, or it's more or less a transition period. And because of that, LIHTC rules still must be honored in order to stay in compliance. So current tenants have to be offered a renewal at the LIHTC going rate as opposed to the market rate. However, should the tenant opt to not renew, we are allowed to actually fill that unit with a full market rate tenant. And currently right now, the owner of the properties is getting about a 250 rent bump, which is absolutely huge. Now, this of course differs from non-LIHTC properties in which a tenant is typically offered a renewal rate slightly below market rate to entice them to stay. The current owner has been experiencing about 1 to 2 units per month of non-LIHTC tenants leasing at the higher rate with zero renovation capital deployed, which means that the opportunity proof is in the rent roll and that the business plan is working, and that backs up our underwriting. And you'll hear more about that in just a little bit. Now, once we are at the end of the LIHTC period, we can then renew at a higher rate, but we're going to gradually do so as we don't want to under promise or over deliver to our investors, especially given today's real estate market, which is seeing a bit of a roller coaster ride. Now, this is not a value add play here with a large capex. We are going to be able to increase the NOI with little capital expenditure. We have budgeted for some necessary capex, like there's going to be some roofs that need to be replaced and some HVAC items as well. But the current owner is implementing what we call a light turn strategy. The plan is not to renovate with new flooring, cabinets, granite, new appliances, etc. What we want to do is just replace items on an as needed basis. And that's what the current owner is doing right now. Very few comps in the area have higher or better finishes than what we have. And so we're just going to continue that same business plan that what the current owner is doing right now. And we're just going to keep going along with it. Now, one of the things that we really love about this is that we are partnered up with a property management company that we worked with previously on several other deals. Now, and because of the LIHTC rules and regulations, this property management company has opted to hire someone specifically to manage these properties. So everything is going to be done by the book and stay in compliance with all of LIHTC's rules and regulations. The property management company is local. They know the market inside and out, and they're just going to help us be able to deliver better returns to our investors. Maria, do you want to hit the next slide for me? We're going to take a look at a few of the exterior and interior pictures of the properties themselves. This is the exterior of Artisan West. And as you can see, it is very well maintained. Landscaping is groomed. Parking lot looks great. The stripes on the parking lot, they look like they're relatively recent. Next slide, please. This is just another angle of Artisan West and then an overview as well. No, oh, thank you. This is Artisan Residential. This is the front of the building. And as you can see on the left-hand side, this is the leasing office. It's very well appointed. So if someone walks into this particular leasing office, they're going to feel extremely comfortable with wanting to lease a space from us. Next slide, please. Here's the back of Artisan Residential. And this is just another angle of the leasing space. As you can see, there's some stainless steel appliances. Again, very clean, very well kept, just a good looking property all the way around. Next slide, please. And here we have Seaside. Now this is more of a ranch style property with 2 bedrooms, 1 bath units. A lot of veterans actually live here. Next slide. There's the back of the property. And then final slide here. And as you can see on the left-hand side, you can see an overview. The roofs look great here. I don't think we're going to have to do anything with this particular property as far as the roof is concerned. Over in the right-hand corner, you can see what the interior actually looks like. Again, it's functional, it's safe, it's clean, and it's working right now. We're just, like I said, going to continue that business plan. Now, one last thing I do want to say is LIHTC generally has a negative connotation that is attached to it. LIHTC properties do. However, as you can see from just the slides, business plan and so forth, the current owner has maintained and done a fantastic job of keeping up with all of these properties. And again, we're just going to continue down that path. Now I'm going to shoot it over to Tim. He's going to talk about underwriting for us.
Yeah, thanks. That was a great introduction or an overview of the different properties. And one of the things that's the most important part when you're buying these multifamily assets is being able to underwrite them correctly. One of the things that's also thrown around all over the place is conservative underwriting, and we're conservative this, we're conservative that. The way that I like to show that we are conservative is I like to show how the underwriting is done, what we're projecting in rent increase, what we're projecting in expenses, et cetera, and so forth. One of the things that is pertinent to discuss is Beth had mentioned that the property is coming out of the LIHTC period, which is also called the sunset or decontrol period. So yeah, we do have to honor the in-place LIHTC rules and regulations. However, if that tenant decides not to renew, then we're able to go fill in that vacant unit with a market rate tenant. So it's very hard for me as an underwriter to predict what the income of the property could be over the next 18 months, simply because I couldn't tell you who's going to stay and who's going to stay and renew their LIHTC lease and who's not. So what I like to do here is show the very top of the screen. You can see that the average monthly rent is $850 in year 1, $920 in year 2, and $1110 in year 3. So just below the $850, you'll see the rent increase dollar. So that is saying that from the current rent average, we're only projecting that the rent overall of the entire portfolio is going to go up $14 per unit. So that's what I believe and would consider as ultra conservative, just because I can't guarantee who's going to come and who's going to stay, who's going to come and who's going to go. So the way that we like to think about this is with all of the units coming out of LIHTC in an 18-month period, which would fall somewhere in the year 2 underwriting, we know that we can give renewal letters to all tenants at market rate rents at that point in time. And people that are just renewing right sight unseen, and they're not having any issues filling the units. So we believe that we'd be able to get the units all up to market rent somewhere between years 2 and years 3. But for conservative underwriting purposes, we said that we're not going to get to average market rent until year 3. You can see in year 3 that we're projecting a $190 rent increase. That's taking into consideration all of the timing of the different leases as they come due and saying that these are the new market rate rents. Now, this is the worst case scenario. Things can only get better from here. As more tenants decide not to renew, they leave and they relocate, or they move to a different property, whatever the reasoning is, the more rent we can push forward towards year 1 and get those rent rates up. In year 2, we do believe that there's going to be more people transitioning, especially we have about half of a year in order to renovate the units and get market rate rents on them. But we're not saying that we're going to get full market rate across the board until year 3. So, ideally in the actuals on how this property is going to operate, we'd love to be able to push that closer to year 1 as much as possible. But because we have to follow the in-place rules and regulations, I'd rather take a more conservative route and say, hey, we're not going to get where we want to go with this property until year 3. If we can do anything sooner than that, that just increases the IRR and the returns overall for everybody that much faster. The expenses that we've budgeted as well, those are in line with what we are seeing across the board in other properties that we own in these areas. We've predicted what the taxes are going to be based on other properties that we've bought. We already have a really great relationship with the property management company. They manage 5 of our other deals right now. So we were able to negotiate a management fee that is much lower than what one person would actually be able to get with them. Because the property is split between 2 cities, it does make it a little bit more difficult for the property management company to manage. So we would have liked to be able to get like a 3 or 3.5% management fee, but there is going to be some more legwork in order to get these property managed. So that's taken into consideration in the payroll and the management fee costs. So we've thought about this property extensively, and we've really put a lot of time and effort in order to justify these expenses and get them to as close as possible to where we're going to actually see them. One thing that I also like to talk about is a lot of people like to talk about conservative underwriting, and sometimes conservative underwriting means that they're not pushing the rents as fast as they could, which we are, but also I want the expenses to be as accurate as possible. I'm not trying to predict that we're going to be able to reduce the expenses much further than what they're currently operating at. I'm just predicting what they could be on a going forward basis based on all of the variables and everything that we know. So if everything goes perfectly, we'll be able to get the rents up higher in years 1 and 2, and we'll see less of an increase in year 3. If that happens, we're also able to get the refinance sometime between years 3 and years 4 instead of at the end of year 4. So there's a lot of different variables that go into here, but the biggest thing is we wanted to set the expectation of the worst case scenario. And the worst case scenario is it takes us 3 years to get to all market rate rents. And then it takes us another year to accomplish the refinance by getting to our target NOI number of just under $900,000. So if we're able to get to that NOI number on a T3 basis much sooner, then we'll be able to refinance much sooner and get everybody's money back into their hands, which is obviously the best case scenario of what we're trying to do with this property.
All right. Thank you, Tim. That's a great explanation. So based on that underwriting, we're going to go over some of the projected returns. And I know this slide kind of spits a lot of numbers out at you all at once. So just stay with me and I'll walk you through it. So we're going to start on the left side here. The first thing you're going to see is that the investors are going to take the first 7% of the profits right off the top. So this comes from your cash flow, which is basically just all the revenue you take in minus the expenses. What's left over is your cash flow, right? So the first 7% of that goes straight to the investors, and there's no sharing with the sponsors there. Once you get over that, then there's a split where 70% of the remaining revenue goes to the investors and 30% goes to those hardworking sponsors who are running the show here. Okay, so that's for their hard work. Now, as an additional incentive, and this is really huge, if we can get the deal performing so well that you've hit 15% returns on your money, then after that, there's a 50-50 split with the sponsors. Again, this is just added incentive for the team to get it to that level as quickly as possible. But just to be super clear about that, that is a 50% split of everything above that 15% mark. It's not retroactive. It's not the whole thing goes to 50-50, just the stuff above that. And you're always maintaining your equity here. So that's another thing to look at. Looking over on the right side of the screen here, we've got the cash on cash. So all that is your cash flow overall divided by how much money you have in the deal. Now, because there's a refi in here, around year 3, 4, those numbers get a little wonky because after the refi, you have less money in the deal. So that equation gets a little funky. So for that reason, I really like to look at the IRR, the internal rate of return. I like this as a measure of the deal because it takes into account not just your cash flow, but also your resale proceeds. And it also takes into account the value of money over time. So we all know that $1 today is worth more than $1 later. So it's kind of putting all of that together and showing you what your returns are when you calculate all of that. So for my personal investments, I like anything over 12%. This is 15 to 17%. So this is really strong. So really love that. After that, it shows the annual average return, which is very similar to your IRR. It's just taking your averages, dividing that by the number of years that your money's in the deal, but it just doesn't take into account the time value of money. So that's the only difference there. Your equity multiplier here is also very strong. So basically this is, if I put $1 in, how much am I getting out? So in this case, you put $1 in, you're going to get $2.20 to $2.50 back. So the money that you're getting back, that is counting your cash flow, your resale proceeds, as well as your capital being returned to you. So you take all of that, divide by what you put into it, and that's your equity multiple. So getting really good returns on here. So the anticipated hold period here is 8 years. Again, if things move faster, that could go a little bit faster. And you're expecting to get your money back in year 4. As Tim said, that could get pushed a little sooner depending on how things shake out, but we're giving you the worst case scenario. But so in year 4, the vast majority of your money comes back, about 95%. But you, again, maintain that equity. So you're still going to get cash flow after and beyond that. So we're going to take a look at what that looks like in an example here. So here we have 3 examples. One where you invested $50,000, one where you invested $100,000, one where you invested $250,000. So we're going to zoom in here if it will allow me. Okay. And we're just going to look at this $100,000 investment. So that kind of shoots right in the middle. So the idea is you invest 100,000. Your cash flow that first year, again, we're in that LIHTC period. Cash flow is not that great the first year, and then it builds over time. So you see that increases over time. Refi, again, looking at year 4, but look, cash flow continues after that. Okay, so this is your equity staying in the deal, continuing to work for you. But in year 4, you are getting $95,639 of your money back, right? So at this point, you only have a little over $4,000 left in the deal. So this is where we're talking about that time value of money. You're getting your money back. You can put that to work in another deal somewhere and continue to get money out of this deal. So that's kind of how that works. Year 8 is when the sale is projected. So then there's sale proceeds of $97,000 and change. You're getting the rest of your equity back. So now you've gotten all of your money back. And so you have your full returns over here. This is what you got from your cash flow. This is what you got from sale proceeds, plus the $100,000 that you put into it initially. All of that is returned. So that kind of summarizes all of it and how we got to those numbers. Hopefully that makes sense. All right, we're gonna turn it over to Angie to kind of summarize why we like this deal.
Okay. Well, both Maria, Beth, and also Tim reviewed a lot of the things that are amazing about this deal, and we do really love this deal. Some of the reasons are increased income with very little capital expenditures. So we talked about the fact that these assets are built in the early 2000s and are very well maintained. So we're going to go in, we're not going to over renovate, as Beth mentioned, we're going to keep them so that they are affordable workforce housing. So we're able to increase the rents, but still provide affordable workforce housing. That leads to the second point. We're staying affordable, but able to increase rents. So current rents are about $250 below market rents, right, for about 70% of the units. So we're able to increase those rents with very little capital expenditures. We may go in and do some paint, may do some carpeting or very light renovations. And then as these units exit LIHTC, we will be able to increase the rents as much as $400 or so per unit. Again, if it's a 2-1 and it's being rented for $1,100 a month, this is still affordable workforce housing. So we are coming in, there is a problem in the area, and we're coming in as a team, and we're providing a solution by keeping these units affordable workforce housing, which is huge. No new supply and tenant demand exists. So we talked about there are no new starts or no new units coming on board in the near future. There's already high demand. These units are already 100% occupied with a wait list. And as money is pouring in, so we talked about Walterboro with companies coming in with money and creating new jobs, there's already a demand. Those wages are going up, and there's even more of a demand for housing there. We're able to increase the value as the asset exits LIHTC, or as the portfolio exits LIHTC. So we're able to increase the valuation of the portfolio by about 30% within 24 months. And this is huge. This is amazing. So this is something to really get excited about. There is an amazing operation team behind this. Tim talked a little bit about that. There are operators within an hour and a half of these assets, which is really important as well. We're keeping the units affordable. Maria talked about the fact that you're investing in, although the whole time is 8 years, you're getting about 90-95% of your capital back within 4 years. So that's huge. You're still able to get equity and get your capital back within about 4 years. Conservative underwriting, Tim talked about that. That is very important. People talk about that all the time. We dove into some of the reasons. We're giving ourselves 3 years to actually get to market rents with actual expenses. And the team already has 5 properties with this property management team, which is also really critical. And then terrific returns. So Maria talked about that as well. Great returns. Okay, so now you're excited about the deal, we hope, and how do you invest? That's a really great question. So reach out to whoever you are connected to on this call, whether it's myself, Maria, or Beth, and we will get a link to you to actually go in, and it's through Syndication Pro. If you don't already have an account with Syndication Pro, you will register and create an account. If you do, you'll simply log in. You can review the subscription documents or the PPM or private placement memorandum. So you sign and execute those, and that can all be done via e-signature, and you'll get the wire information for the funding. You will submit your wire, and then you sit back, relax, and enjoy your returns. That being said, this is a first come, first served basis. So we are really excited about this opportunity and this offering, and we hope you are as well. All documents and funds need to be in by September 14th at the latest. We do expect this offering to be oversubscribed. So if you're interested, please jump in as soon as possible. Once we are subscribed, we will move everyone over to the wait list that didn't make it in on time. So please reach out to us today. And I think that is everything. Thank you so much for your time. We hope you're as excited about this offering as we are.
Thanks, everybody. Take care.